大家好，我们看一下这张图，非常血腥。这几个星期，方舟基金的几个 ETF 和权重股 Tesla 都跌了很多，所以 Cathie Wood 最近发布的3月5日的谈话，对很多投资人的各种担心做出了回应。我们来一起学习一下吧。原视频将近42分钟，我把要点浓缩到了10几分钟。我们开始吧。
We have a 5-year investment time horizon. Our minimum hurdle rate of return for any stock to enter our strategies is 15% at a compound annual rate over 5 years. That's a doubling over 5 years. It's just a projection. We could be wrong. To give you an example, electric vehicles. We expect unit sales of electric vehicles globally, including China, to compound at an 82% annualized rate during the next 5 years.
这是方舟基金最近1个月电车股的持仓变化。方舟在过去1个月中加持了100多万股 Tesla， 持股数量增加了 24.4%， 但是 Tesla 仓位的市值却跌掉了 13.9%， 这是因为 Tesla 股票从高点跌掉了 30% 多的缘故。
I have managed money in all kinds of wrappers. The ETF wrapper has been the easiest. And the reason is I do not have to deal with the flows, either inflows or outflows around any of our strategies. All I need to do as the portfolio manager is make investment decisions. And so we trade around volatility regularly. We expect volatility.
他为什么要说这段话呢？而且浓墨重彩地解释 ETF 的生态系统。在他解释之前，我们有必要做个科普。我在最近3期的视频里面都提醒大家要应对做空基金对 Tesla 的攻击，其中提到了一个江湖的传闻。这个传闻是说有人看不惯木头姐姐，要把他打下神坛。打他的办法就是攻击他的权重股，股价下跌会引起投资者恐慌。投资者撤资，木头姐姐必须卖股变现才能有钱给要求撤资的投资者。于是 Cathie Wood 在甩卖自己的权重股时被迫站到了自己的对立面，加速了权重股的下跌，坠入死亡漩涡。这种说法可能混淆了开放式共同基金和 ETF 的区别，所以 Cathie Wood 在下面会解释 ETF 的生态系统。但是他的解释对于隔行如隔山的圈外人未必足够，所以我来补充几句。ETF 和开放式共同基金有相似之处，但是 ETF 并不直接与投资人交易，这是 ETF 与开放式共同基金最大的差别。在 ETF 和投资人之间有一个角色叫做 Authorized Participants， 通常由传统的投行，比如高盛、花旗、小摩、大摩、美国银行等等来担任。一个 ETF 可以有10几个甚至几十个 Authorized Participants， 这样可以增加流动性。Cathie Wood 刚才提到了，他只需要做出投资决策，市场上有人愿意投资方舟基金，那些 authorized participants 就会接受投资人的钱，然后按照 Cathie Wood 的投资策略买进或者卖出股票，同时把 ETF 的股份卖给投资人。如果这些人要撤资 authorized participants 就卖掉股票，把钱拿出来给投资人。比如 Tesla 大跌，投资人纷纷卖出 ARKK 的股份，举个例子，花旗银行就会接过这些 ARKK 的股份，按照市价把钱交给投资人，同时在花旗银行自己的 ARKK 账户里面按照比例减少 ARKK 的成分股，然后告诉 Cathie Wood 的 COO或者 COO 手下的人， COO 在电脑里面减掉这些股份就完事了。这就是 Cathie Wood 等会儿要说的方舟基金之外的 ETF 生态系统。换句话说， Cathie Wood 不用直接面对投资人的压力。由此可见， Authorized Participants 为方舟基金提供了非常大的减震和抗压的功能。刚才说的只是一个传闻，因为至今没有人公开站出来说他在做空方舟基金，但是的确有人站出来说他在做空方舟基金的权重股 Tesla， 这是2个概念，我等会儿再重申一次。做空 Tesla 的领头人物就是图中这个 Michael Burry。上个星期五很多人告诉我他们抄底了 Tesla， 我觉得这个时候还是以防守为主。虽然 ETF 的架构能够保护好 Cathie Wood， 但是未必能保护得了 Tesla。
And so we have an ecosystem outside of ARK. This wrapper and the ecosystem around it is extremely liquid. we were approved as a fully transparent, active equity ETF. We have to disclose our holdings at the end of every day. You know, it's developed a life of its own out there. There are YouTube videos and blogs and so forth around it. The young retail investor, they want to understand what is going on. They love transparency. And so we try to provide as much of that as possible. I think that there is a big difference between the way institutional investors look at investing and retail investors. A lot of institutions are not set up actually to analyze a stock like Tesla. The reason for that is institutions tend to be very benchmark sensitive.
这一段关于方舟基金的分析师和传统机构的分析师之间的区别，对于很多人来说不知道有什么用，我个人觉得非常有用，所以不但提取出来，而且增加了很多补充说明。传统机构的分析师有两种，一种是 sell side 的分析师，另外一种是 buy side 的分析师。一般情况下 sell side 的分析师在投行里面是为 sales and trading 服务的，他们的工作性质其实非常类似于记者，通过采访公司高管和阅读报表和其他材料，组织出一篇文章，得出一个看涨看跌或者暂时应该观望的结论。他们的结论正确与否与他们的工资奖金并无直接关系。当然了，如果运气不好，出错率太多或者惹恼了大客户，还是要倒霉的。只要他们能为 sales and trading 带来生意，就可以舞照跳，酒照喝。在这种机制下，经常在 CNBC 上面露面的分析师参加会议侃侃而谈，混个脸熟，然后多参与 sales 的客户会议，帮助 sales 拉到更多生意，更容易让 sales side 的分析师得到提升和拿到更多的奖金。为什么有些分析师经常错得极其离谱，但是却仍然满脸信心爆棚的去出镜去见客户？不但是因为有上述机制在起作用，而且他们中的很多人在这一行第一次被打脸的时候，他们的师傅是这么安慰他们的，就是 Don't worry about it Never underestimate the stupidity of your clients. They come to you because they believe that you know more about it than themselves. 这是我亲耳听到的一个 sales side 的分析师说的话。久而久之，分析师们就锻炼出了一种神功，就是我即使错了，也比你对的有道理。传统机构里面另外一种分析师就是 buy side 的分析师，是为基金经理服务的。等会儿 Cathie Wood 要提到一个词叫做 career risk， 就是职场风险。buy side 的分析师很少自己做分析，为什么呢？因为一个 sell side 的分析师一般情况下也就只要分析一个行业，甚至一个分支行业里面的几个公司，就可以大碗喝酒，大块吃肉了。但是 buy side 的一个基金里面有几十个甚至几百个跨行业的股票，只有很少的分析师没有时间做一手分析，在大多数情况下只能把各个公司的 sell side 的分析师的报告拿来做二手分析。这样做的好处不仅仅是节省了时间，而且万一错了可以有缘可查，甩起锅来分外容易。不会甩锅的分析师不是一个合格的古惑仔。下面 Cathie Wood 说的很委婉礼貌，实际上我的理解就是最普通的最有用的甩锅就是甩给对标指数。
And I'm going to use Tesla as an example here. Tesla, as you know, did not enter the benchmarks until last fall. And we're happy that institutions are joining us now. But they're joining us primarily because Tesla entered the indexes. Their auto analysts tend to follow the traditional auto industry. We began to invest aggressively as we saw battery pack system costs decline as rapidly as they have been declining. The other difference is time horizon. Institutional investors are much more short-term. This idea of being graded every year based on how well an analyst or portfolio manager did relative to a benchmark is quite constraining. The luxury we have, and retail investors have, is retail investors really don't have career risk. We have a 5-year time horizon. That is a luxury. That's a luxury. Linear growth and exponential growth trends. You give that a few more years, and the difference is quite surprising. I mentioned that 82% growth rate. We really believe that's going to happen. I don't think traditional auto analysts believe that could happen. The third issue that institutions are grappling with, that we are not, and that retail investors are not, is that the analysts are very siloed and specialized by industry or sub-industry or sub-industry. The problem with that is these new innovation platforms are cross-sector. It is very difficult in a traditional institution, which is very siloed, to have analysts collaborate in that way. They haven't been set up to collaborate. Our analysts are all about collaborating. We are receiving insights because we're willing to share our research. We're receiving insights about our research from those in the field. Are we making incorrect assumptions? That would be good to know early in an exponential growth trajectory, because if you make an incorrect assumption in the early stages of investing an exponential growth trend, and you carry that mistake out, you can make big mistakes. Because of their focus on benchmarks, is going to cause their portfolios to populate increasingly, we believe, with value traps. So we're a good hedge against the broad-based benchmarks. The last few weeks hasn't done anything except increase the returns that we expect from each of our stocks to the extent they've come down. We are not in a bubble. These 5 innovation platforms involving 14 technologies, the seeds for all of them were planted more than 20 years ago. They were actually the dream at the time. The dream was right. We're in the period of reality. The seeds are beginning to flourish. Chairman Powell of the Federal Reserve, I think a lot of investors wanted to hear him say, yes, we're going to try and control the yield curve. That really has never worked in our country. We believe that interest rates going up from 1% to 1.5% on the 10-year Treasury in the span of a few months is like a tsunami through the bond market. That's a 50% increase in yield. We believe are suggesting that real growth is going to pick up. We could see the CPI in the 3 to 4% range. It will be temporary. So I think those two forces are going to combine. The one deflationary force is good deflation and will spur growth. The other force is deflationary and bad in that it will probably lead to duress and bankruptcies and reorganizations and so forth. Fiscal policy, government spending is nothing more than future taxation in one shape or form. The fiscal stimulus has been in place for about a year now, and with that is going to come taxation. But I will say the closer we get to next year, the lower the odds of some very harmful taxes, because we'll be looking into a congressional election year, and the House is very close in terms of the number of Democrats and the number of Republicans. I can tell you that's not good news. The employment report was a very good one, much stronger than expected. Again, looking into the guts of it, there was a big offset. The average work week dropped by 0.9%. So that's month to month. So we think the two pretty much wash each other out. We still think we're in a V-shaped recovery. Interest rates have gone up this week. I think that's a manifestation of growth that's revving up and is going to gain more momentum as the vaccine spreads. A lot of investors say, well, interest rates have gone up. Of course, this is a killer for your strategy. I don't think the market's ever priced in interest rates at 0.5% on the 10-year Treasury, or today 1.5. I think that the market has been assuming that interest rates would normalize somewhere in the 4% or even 5% range. We we got to sort of a normalized PE in the 20 to 25 range. We don't think the market has priced any of these low interest rates in. To say that these strategies should go down because of interest rates, we just don't buy. Let's address the equity market. There's a big rotation taking place. It's moving from growth into value. Now, this started in the fourth quarter, and the surprise to us is that our strategy had held up as well as it did until the last 2 weeks. We were beginning to think, oh, maybe they can coexist. Well, we don't think they can coexist. We think that they're going to be very wrong because those kinds of value stocks probably haven't been investing very aggressively to become a part of the new world and the innovation that's burgeoning today. And even retail, many people say, well, can't possibly hurt retail any more than it already has. I can tell you that's not true. So if you look in the United States, online retail as a share of total retail is roughly 20% now. It grew at 4 times the pace in the last year as it did the prior 4 years. If you look at S-curves, where does the sweet spot occur? It starts happening in the 10% market share, 15, 20, and then there's the takeoff. If you look year to date, energy stocks are up 37.5% and financials up 13%. Much of that occurred in the last month. 22% increase in energy just in the last month and 8% in financials. So that accelerated appreciation is what has caused this rotation algorithm saying, okay, past is prologue, it's happening faster, let's get rid of our growth stocks and let's go into value. The fact that those two sectors are at the top of the league tables this year and in the last month makes me feel good. One, the bull market has broadened out. It did not narrow into one strategy. So this rotation is healthy, a good correction, shakeout is healthy, great time to average in to strategies you like. And I do believe, on the other hand, that energy and financial services are going to be two of the most disrupted sectors thanks to electric vehicles, autonomous electric vehicles, and thanks to digital wallets. Those are two and three of the biggest opportunities brewing out there. So the fact that energy and financials are leading the pack suggests to me that this is not going to be long-lived. There are rules like, okay, let's follow the price momentum. Just it's a Momo trade. And again, if truth is going to win out, that will be a losing strategy. Cash and money market mutual funds soared during 08-09 for understandable reasons. There was so much fear. I was surprised to see that cash in money market mutual funds, now maybe there's a technical explanation, but I don't think it can be this big, is higher now than it was in 08-09. It had started to come down, and now it's moving back up again. I think this makes sense because equities have seen outflows pretty consistently since 08-09. Fixed income has seen inflows. These last 2 weeks probably has renewed the decline in equity outflows, and yet at the same time potentially a decline in fixed income, especially long duration fixed income funds. What do you do with that? You put it into cash. The cash is building on the sidelines. And we do believe there is going to be an asset reallocation. You could see it towards stocks and bonds away from cash. Bond yields have gone up. Let's extend our duration so that we earn a little bit more on our money. And for stocks, let's have a barbell strategy: bonds and equities, maybe even higher octane equities.